Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Vulcan Materials is the largest producer of construction aggregates in the United States, headquartered in Birmingham, Alabama. It mines crushed stone, gravel, and sand, the materials underlying every road, bridge, and building.
Aggregates are essential but unglamorous. Before construction begins on any large project, enormous volumes of crushed stone must form a stable foundation. Vulcan's quarries supply that raw material to markets across 22 states and growing.
About 82% of revenue comes from aggregates. Asphalt mix and concrete contribute the rest. But aggregates drive nearly all the earnings power, combining pricing leverage with a low incremental cost structure.
The economic moat is physical. Vulcan owns quarry land near major population centers. New quarry permits near cities are nearly impossible to obtain, making Vulcan's existing reserves an irreplaceable and permanent competitive position.
The transportation cost moat reinforces location advantage. Aggregates are heavy and low value per ton, so shipping them far exceeds the product cost. Each quarry creates a localized supply monopoly within its delivery radius.
The main demand drivers are public infrastructure spending and private construction. Highway bills, state transportation budgets, and data center construction all require large aggregate volumes. Infrastructure spending tends to be multi-year and non-discretionary.
The unit economic story is pricing power. Aggregates gross profit per ton has risen consistently as Vulcan implements annual price increases above input cost inflation, a pattern that compounds cash flow over time.
Vulcan and Martin Marietta form a two-company duopoly at the top of the U.S. aggregates market. Both operate with similar structural advantages. The key differentiator is geography. Vulcan's Sunbelt footprint aligns with the fastest-growing U.S. markets.
CEO Tom Hill has led Vulcan since 2014 and oversaw the 2022 acquisition of U.S. Concrete, deepening vertical integration into ready-mix concrete and expanding presence in key urban markets.
Vulcan has raised its dividend for 14 consecutive years, paying about $2.24 annually. The modest yield reflects the premium valuation investors assign to irreplaceable reserves and durable pricing power.
Free cash flow is strong enough to support both acquisitions and dividend growth. Capital allocation focuses on expanding existing quarry throughput and making bolt-on deals to add reserves in high-demand markets.
A useful mental model. Vulcan is a long-lived royalty on U.S. construction activity. Quarry land appreciates as development surrounds it, and pricing power improves as alternative sources grow more distant.
Aggregates pricing and volume, combined with the trajectory of public infrastructure spending, are the two variables that matter most in any reporting period.
Vulcan is not a high-growth story. It is a durable compounder with permanent moat characteristics and a decades-long tailwind from the infrastructure needs of a growing population.
That's the company chapter for Vulcan Materials. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Vulcan Materials just dropped a Q1 2026 quarter that proved the aggregates monopoly thesis is alive and compounding. Revenue up 7.4% to $1.76 billion. EPS came in at $1.35 versus the street's $1.10 estimate, a 22.7% beat. Aggregates shipments up 5%. Freight adjusted price per ton up 3.5%. This is Charged Alpha. Let's break it down.
Vulcan Materials is the largest United States producer of crushed stone, sand, and gravel, collectively called construction aggregates. Market cap is $38.3 billion. The business operates roughly 400 quarries, distribution yards, and production facilities across 22 states, primarily in the Sunbelt, where population growth is highest. Aggregates feed everything: highways, bridges, airports, data centers, residential foundations, commercial buildings.
Here's what makes Vulcan structurally different from almost any other industrial business. Aggregates are a near monopoly. Quarries are permitted once per location, and they cannot be relocated. Once you own a permitted reserve near a growing metro, you have a multi-decade local monopoly because trucking stone more than 50 miles destroys the economics. The Infrastructure Investment and Jobs Act, the IIJA, is the primary federal tailwind, funneling tens of billions into highway and bridge spending through 2026 and beyond.
Let's walk Q1. Total revenue was $1.76 billion, up 7.4% from the prior year quarter. EPS landed at $1.35 against consensus of $1.10, a 22.7% beat. Adjusted EBITDA was $447 million, up 9% year over year, with EBITDA margin at 25.5%. Operating margin was 15.1%, up 130 basis points. Gross margin expanded across every segment.
Now, the aggregate-specific metrics, these are the numbers that actually drive the stock. Aggregate shipments hit 50.0 million tons, up 5% from 47.8 million tons last year. The freight-adjusted sales price per ton, the FRAP, was $22.80 per ton, up 3.5%, or 77 cents. On a mix-adjusted basis, freight-adjusted prices were up 4%.
The killer number for an aggregates investor is gross profit per ton. Aggregates segment gross profit was $400 million in the quarter, up 12%, which works out to $801 per ton. Aggregates segment gross margin expanded 90 basis points to 27.6%. Cash gross profit per ton was $11.38, reflecting the compounding benefit from the January 1st price increase. Vulcan's stated long-term target is $20 per ton in cash gross profit.
Translating that, Vulcan is currently capturing roughly 57% of its long-term per-ton profit target, and that gap is the bull thesis. Every dollar of additional cash gross profit per ton on 50 million tons per quarter equals $50 million in incremental quarterly EBITDA at very high incremental margin, because the cost base of running a quarry is largely fixed.
On the cash and balance sheet side, trailing free cash flow is $1.135 billion. Operating cash flow this quarter was $543 million. The company ended with $183 million in cash against $5.4 billion in total debt. Net debt around $5.22 billion. Total equity sits at $8.55 billion. Net debt to EBITDA is in the manageable 2x range given the fee EBITDA generation profile.
The debt level is worth flagging. $5.4 billion in debt against $1.1 billion in free cash flow is a 5 times debt to FCF ratio. That's serviceable in the current rate environment, but it does limit the size of M&A Vulcan can pursue without issuing equity. The aggregates roll-up strategy is real, but it's funded out of disciplined leverage, not aggressive borrowing.
Analyst coverage on Vulcan is hold heavy. The breakdown is 4 buys, 8 holds, and 0 sells. Average price target is $323.77. With the stock at $293.02, that implies upside of roughly 10.5% to consensus. The hold-heavy mix is unusual for a business of this quality, and it's worth understanding what it actually reflects.
Here's the key nuance. Hold ratings on Vulcan are not a quality concern. They are a valuation concern. Aggregates trade at a premium EV to EBITDA multiple versus the broader basic materials sector, typically 18 to 22 times, because the quarry permit moat is genuinely durable. Every analyst we've read calls the business excellent. The debate is entirely about entry price, not the underlying franchise.
Forward estimates are calibrated to 9.3 EPS for fiscal 2026 and revenue of $8 billion. At $293, the stock trades at roughly 31.5 times forward earnings. That looks expensive at first glance, but bull analysts argue aggregates deserve software-like multiples because the cash flow profile is closer to a utility than a cyclical industrial.
The bullish case from sell-side analysts: IIJA spending hasn't peaked yet. Public infrastructure dollars typically take 18 to 24 months to translate from appropriation into actual quarry shipments. The biggest IIJA volume tailwind is still ahead of Vulcan, not behind it. That's why the company guided to maintain full-year adjusted EBITDA between $2.4 and $2.6 billion.
The bear side holds focus on 3 things. Number 1, the stock has already re-rated significantly over the last 3 years. Number 2, Private construction, residential and non-residential, could weaken if rates stay elevated, offsetting public infrastructure gains. Number 3, at 31 times forward earnings, there's no margin of safety if either the IIJA ramp slows or input costs spike.
The bull case rests on three pillars. First, the IIJA spending ramp is still building. Federal highway and bridge appropriations have been authorized, but the actual project execution and aggregates orders flow downstream over multi-year timelines. Vulcan's volume tailwind from public infrastructure is durable through 2028 at minimum.
Second, structural pricing power. The January 1st price increase is now compounding through the year. Aggregates pricing has historically tracked at or above inflation regardless of macro cycle because supply is permit constrained. Cash gross profit per ton at $11.38 against a $20 target gives Vulcan a long runway of margin expansion without needing volume growth.
Third, quarry permits as a moat. New permits are essentially impossible to get in most growing markets. Environmental review, community opposition, and zoning all work against new entrants. Vulcan's existing reserve base in the Sun Belt is irreplaceable. That's a structural competitive advantage that compounds quietly every year as those reserves get more valuable.
The bear case starts with construction sensitivity. Aggregates demand is split between public infrastructure and private construction. Public is funded and ramping. Private, both residential foundations and non-residential commercial, is rate sensitive. If the Fed holds rates higher for longer and private construction starts decelerate, that could partially offset the IIJA tailwind.
Weather is a real variable, especially in Q1. Aggregates volumes are weather dependent because you cannot pour concrete or pave roads in the rain. A wet spring or harsh winter can knock 5 to 10% off quarterly tons. That 5% volume growth this quarter benefited from relatively favorable weather. That won't always be the case.
Valuation is a genuine concern. The stock trades at 31 times forward earnings and a premium EV to EBITDA multiple. If sentiment shifts, even modestly, the multiple compression alone could drive a meaningful drawdown without any change in business fundamentals. Premium multiples are vulnerable to any whiff of growth deceleration.
The fourth bear point is debt relative to free cash flow. Vulcan carries $5.4 billion in total debt against $1.1 billion in trailing free cash flow. That's a 5 times ratio. It's serviceable today, but it constrains how aggressively Vulcan can pursue acquisitions, especially in a downturn when leveraged buyers face tighter credit. The roll-up engine is real, but it's not unlimited.
Vulcan's primary peers in aggregates are Martin Marietta, ticker MLM, Ireland-based CRH, and Summit Materials, ticker SUM. Among those four, Vulcan and Martin Marietta are the two pure-play United States aggregates leaders. CRH is a global building products giant with much broader product mix. Summit is the smaller domestic challenger.
Versus Martin Marietta, the comparison is almost stride for stride. Both companies operate similar Sun Belt-weighted quarry footprints. Both report comparable per-ton economics. Vulcan tends to trade at a slight valuation premium because its asset base is marginally larger and its IIJ exposure is higher. Investors typically own one or the other, not both, given the redundancy.
CRH is the most diversified comparable. Ireland headquartered, listed in New York, with cement, asphalt, and aggregates spanning the United States and Europe. CRH trades at a meaningfully lower multiple, typically 12 to 15 times forward, but it has more exposure to cement, which has different supply economics than aggregates and lacks the same permit moat.
Summit Materials is the speculative aggregates name. Smaller, more leveraged, more acquisitive. Summit has been periodically rumored as a takeout target for either Vulcan or Martin Marietta. Trades at a discount to the majors but carries higher execution risk. For investors who want aggregates exposure with less premium valuation, Summit is the alternative, but you accept management and balance sheet risk in exchange.
Options activity around Vulcan's earnings was relatively quiet. Implied volatility ahead of the report priced roughly a 4% move. The actual reaction was modest. The market had largely calibrated for a beat given how aggressive the January 1st price increase was, and the EPS surprise of 22.7% was absorbed without a dramatic move.
Longer-dated options show call open interest concentrated at the 320 and 350 strikes for January 2027 expiry, consistent with positioning for the consensus price target to be reached over the next 12 months. Put activity is concentrated at 250 and 260, representing downside hedging by long-term holders concerned about a potential macro construction slowdown.
On the insider side, Vulcan executives sell shares predominantly through pre-scheduled 10b5-1 plans, which is standard for industrials of this size. There's been no unusual cluster buying or selling around the quarter. CEO and CFO holdings remain meaningful, and the share count has been stable. Vulcan does not run an aggressive buyback program comparable to mega-cap tech.
Institutional ownership is well over 80%, dominated by Vanguard, BlackRock, and State Street Index funds, plus active managers like T. Rowe Price and Capital Group. The float is tightly held by long-only institutions. That ownership profile means the stock tends to trade with relatively low retail volatility, and it follows index flows more than headline news.
Bottom line on Vulcan: elite aggregates business, structural moat, IIJA tailwind compounding. Q1 numbers were excellent across every aggregates KPI. Volume, price, and gross profit per ton all moved the right direction. The thesis is working as designed.
If you own it, hold through the IIJA ramp. The volume tailwind is durable. New buyers should respect the valuation. 31 times forward earnings demands patience. Charged Alpha rates this a watch list hold. Outstanding business, fair to rich entry. Wait for a pullback toward 270 before adding.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.